Hello, this is a video report analysis of Denbury Resources, Inc. as part of Birkenroad Reports program of Tulane University A.B. Freeman School of Business. The analysts include Kelsey Bainsfather, Annalise Broussard, Craig Cassidy, Hannah Hausman, and Layla Nashed, and the investment research manager is Elizabeth Garrity. Denbury Resources, with ticker symbol DNR, is headquartered in Plano, Texas. Denbury is an independent oil and gas exploration and production company that specializes in tertiary recovery, also known as enhanced oil recovery, or EOR. Before commencing EOR, Denbury engages in primary and secondary oil recovery. As of this report, Denbury Resources trades at $18.61. Denbury's market cap is $6.95 billion, with 373.5 million shares outstanding. The company has an enterprise value of $10,190 million. Denbury's total amount of proved oil and gas in its reserves at the 2012 year-end is approximately 451 million barrels of oil equivalent. 82% of Denbury's total reserves are oil and 18% are natural gas. Denbury's stock price is highly correlated with the fluctuations of the price of oil and gas, as seen in this 5-year snapshot of the stock's performance. The stock's performance is highly dependent on the volatility of the two commodities. Before we get too far into this analysis, it is important that we explain the EOR process, which gives Denbury its competitive advantage. When Denbury begins production on a previously undeveloped field, it first uses primary recovery, which involves using the natural pressure of the reservoir to push oil to the surface to extract about 20% of the well's total reserves. When natural pressure falls within a well, Denbury moves to the secondary recovery phase, which entails the injection of water to drive an additional 18% of the reserve's oil and gas to the surface. Finally, through tertiary recovery, Denbury injects CO2 into the fields to produce an additional 17% of the total reserves. Denbury must first secure a supply of CO2 and then transport this commodity through pipelines to the field's injection well. The CO2 then moves through the field, mixing with the oil droplets, expanding them, thus moving the oil up to the producing wells at the surface. Though securing and transporting the CO2 can be costly, tertiary recovery involves the least amount of risk because primary and secondary reserves have already proved the presence of oil. Currently, Denbury owns fields in both the Gulf Coast and the Rocky Mountain regions. The company strategically operates in these regions because it has access to large amounts of CO2 and necessary pipelines. In the Gulf Coast region, Denbury has an estimated 201 proved million barrels of oil equivalent, with fields in Texas, Louisiana, and Mississippi. Denbury's main access of CO2 for the Gulf Coast region is the Jackson Dome, which it acquired in 1999 and is the largest supply of CO2 east of the Mississippi River. Denbury also operates in the Rocky Mountain region, with fields in both Wyoming and Montana. The company gets its CO2 supplies for these fields from Riley Ridge and recently acquired access to ExxonMobil's LaBarge. In December 2012, Denbury finalized the Bakken Sale and Asset Exchange with a subsidiary of ExxonMobil. In exchange for Denbury's Bakken assets, Denbury received $1.3 billion in cash and an interest in ExxonMobil's CO2 reserves at LaBarge Field in Wyoming. Denbury also received operating interests in the Webster Field in Texas and Hartsog Draw Field in Wyoming. On January 14, 2013, Denbury entered into an agreement with ConocoPhillips to acquire additional land in the Cedar Creek Anticline, using $1.05 billion received in the Bakken Sale and Asset Exchange. Denbury plans to extend the Green Corps pipeline to deliver CO2 to the Cedar Creek Anticline fields and estimates that the Cedar Creek Anticline fields hold 260 to 280 million barrels of recoverable oil, increasing daily production by approximately 7,700 barrels of oil. Denbury also acquired 100% working interest and 84.7% net revenue interest in Thompson Field in June 2012 for approximately $366 million. The field is located 18 miles west of Hastings Field, and Denbury plans to extend the Green Pipeline to begin CO2 flooding. Future expectations of production and capital expenditures provide a positive outlook for Denbury's cash flows in the coming years. Production and capital expenditures have both been growing at steady rates in the past few years, which have caused the increase in capital expenditures to offset the growing production, leaving free cash flow negative. However, we expect production to continue to grow in the next 10 years, but we expect capital expenditures to begin to decrease around 2017. This combination means Denbury will have a positive and increasing free cash flow. Denbury already has a significant amount of cash on its balance sheets, and with the addition of free cash flows, it will allow for the possibility of paying dividends to the company's shareholders. Using the present value 10 valuation model, our team determined a 12-month target price of $22 per share for Denbury. The present value 10 model is an appropriate valuation method for Denbury as it incorporates both future production rates and oil prices. A discounted cash flow model fails to accurately value Denbury because of the significant capital expenditures associated with enhanced oil recovery. Similarly, a peer group multiples valuation also fails to correctly value Denbury as the company's focus on enhanced oil recovery leaves it without a truly comparable peer group. Thank you for listening. Produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.